And happy Friday once again, options traders. Well, I received a nice email from one of our traders asking about what is triangular arbitrage. And this question came up from a recent article talking about the US dollar Japanese yen, that it traded at an all-time high of 150. This is the highest since 1990. So one US dollar now equals 150 plus Japanese yen. Well, in this article, they had also mentioned about triangular arbitrage, and he had just said, what in the world is triangular arbitrage? So, good question. Let's go find out. And as always, before we do, please be sure to click like and subscribe. Helps to promote the channel and is always very much appreciated. So, triangular arbitrage, what is it? Well, it applies only to currency trading. And so, for example, what you're going to do is you're going to take three different currency quotes. We might have the US dollar in terms of yen, US dollar / Japanese yen. Then we might take the euro US dollar, and then we need what's called a cross rate. In this case would be the euro Japanese yen. So notice what's going on here. In the first quote, we have the US dollar. In the second quote, we have the US dollar, but relative to a different currency. But in the third quote, I don't have the US dollar. I just have the remaining two. So I've got Japanese yen and euro. This is called a cross rate. Now, depending on which definitions you look at, you might even get different interpretations of what a cross rate is. Some people will say that a cross rate is any currency quote that does not involve the US dollar, such as the euro in terms of yen. But probably the more technically correct definition is when you have a currency quote that does not include the home currency. So for the US, because we trade in dollars, yes, the euro Japanese yen would be a cross quote or a cross currency quote. But if you were in Japan, this would not be. So even that kind of causes some confusion. So it really depends on what you're looking at. But regardless, the way that you need to set up triangular arbitrage, again, you're going to need a currency quote. So I've got US dollar Japanese yen. You're going to need another one that will replicate one of the previous ones. So I need to have US dollar or Japanese yen in the second one. So I've got euro US dollar. And then in the third one, you need the remaining two. So these two have US dollars in common. I would need euro and Japanese yen. Now, something else to understand is that in order to figure out triangular arbitrage, you have to set up your quotes in a special way. And so that's why I've set these quotes up in these formats: US dollar to Japanese yen, euro to US dollars, and then euro to Japanese yen. And the reason I did this is that this is going to help you to see where the arbitrage is coming from. Now, the reason it's called triangular arbitrage is that what's causing the arbitrage, which remember is a way of getting free money just because of some discrepancies with pricings in the market. So maybe we start with US dollars, convert them to Japanese yen, and then we take them to convert the Japanese yen into maybe euros, and then I take the euros to convert them back into US dollars. So notice that once we've come back round trip, I'm holding US dollars, which are, of course, quoted in US dollars. So I started with US dollars and I end with US dollars. But what I'm doing is I'm kind of taking this little three-step triangle, I'm converting them to something else, and then I'm converting it to something else, and then I'm bringing those dollars back home. And so it's really this three-step process that allows us to, let's say, start with dollars and end with dollars. But because we're taking this intermediate step here, it's very easy to figure out that, hey, these quotes might not be exactly balanced. And that's where the arbitrage comes in. So let's take a look at a simple example. Now, I know these numbers are nowhere near accurate, but I'm doing it just to make it easy to follow. Let's say the US dollar in terms of Japanese yen is 2. Now, remember what this means. The currency on the left is always 1 unit. So 1 US dollar equals 2 Japanese yen. If we look at the euro US dollar quote, let's say it's 0.10. This means that 1 euro equals $0.10 or 10 cents. Now again, notice in these quotes, I've got US dollars in the first one, US dollars in the second. So now we need the cross quote. And so we would use Japanese yen, euro. Depending on how we've got the quote set up, it might be euro in terms of Japanese yen. But let's say that the Japanese yen euro quote is 5. And again, this means 1 Japanese yen, 1 unit on the left, is equal to this many of the currency on the right. So with these numbers, would we be able to create an arbitrage? Well, again, the reason that I've laid these quotes out in this order, in these formats, is this. This makes it much easier to see. Notice if we have US dollars in terms of Japanese yen, and then Japanese yen in terms of euro, or in other words, I'm going to convert my yen into euros, and then I'm going to convert my euros into US dollars. Just think of it like math. If we have a denominator that matches the numerator, we can just cancel them out. So if I take my dollars and convert them to yen, and then convert the yen to euros, I've effectively converted the dollars to euros. If I convert the euros to dollars, these cancel, and look what happens. I have US dollars where I started, and I end up with US dollars. And so that makes it much easier to see where the arbitrage can arise. So these are the numbers that we were assuming. So let's check and see if we could get some free money out of this arrangement. Let's start with, and it doesn't matter, we could start with $1, $100, 1,000, but we start with some number of dollars. We convert them to yen. And according to this, we're going to end up with 2,000 Japanese yen. Now we're going to take our yen over here and convert them to euros. 1 Japanese yen equals 5 euros. So we're getting an expansion or a multiplier of 5 to our amount. So we're going to go from 2,000 yen to 10,000 euros. And then I'm going to exchange my euros for US dollars. So 1 euro equals 0.10 US dollars. So now we're going to end up with 1,000 US dollars. So notice that we started with $1,000, we ended with $1,000. There's nothing to be made or lost there. But let's say that these quotes, again, in the real world, are probably not going to be absolutely perfect at every moment in time. Now, just to exaggerate it, let's say that this Japanese yen euro quote was actually at 6. What's going to happen now? Well, I can now take my 2,000 yen and convert them to euros. I'm going to end up with 12,000 euros, right? Multiply by 6. And when I convert my euros to dollars, we just get 10% of that. I'm going to end up with 1,200 bucks. So I started with 1,000, I end up with 1,200. That's free money. It's free 200 bucks. So what arbitrageurs are going to do is they are going to borrow money, lots of it, go through these steps, and end up paying back this loan and keeping the balance. So in this case, we would pay back the 1,000 bucks and have $200 as an arb profit in our pocket. But remember, with arbitrage, it undoes the benefit. So these situations don't last long. So what's going to happen? Well, as we start selling dollars and buying yen, it's going to drive this quote down. As we start selling yen and buying euros, it's going to drive this quote down. And as we start selling our euros and buying dollars, it's going to drive this quote down. And that means that this number will ultimately get driven down as well. And so eventually the arbitrage undoes the very benefit. So it's kind of a nice thing to understand about triangular arbitrage, and just realizing that no matter what quotes you're looking at, that there's a mathematical connection between them all, and they are all, for the most part, going to be exactly fair. So the big question, can you make money if you're a currency trader out there? Well, the short answer is no, unfortunately. Arbitrage, especially by today's standards, is carried out by computers at lightning speed. And the one thing that you do get from it as a benefit is to understand that triangular arbitrage keeps cross rates fair for everyone. But forget about logging onto your platform and trying to look for triangular arbitrage and trying to make money from it. It is just simply not going to happen. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.